Welcome back. So, if you've been gleaning financial headlines, you may be asking, what is this inversion of the yield curve thing and why is it so scary? Well, an inverted yield curve marks a point on a chart where short term investments in U.S. Treasury bonds pay more than long term ones. And when they flip or invert, it's widely regarded as a bad sign for the economy. Now, that being said, some economists are saying that in this case, a recession may be unlikely. On the phone with us from Seattle is Zach Abraham with Bulwark Capital Management. And Zach, why do you disagree with these other assumptions?
Well, I think that first of all, I'm not an old man, but I've been doing this long enough to remember the last time the yield curve inverted, and the exact same thing was said then. I do not know why. I've never really understood it, but there seems to be an incredible reticence among market watchers or market strategists to say that we're going into a recession. I don't know why. The upside is always, the bias is always to the upside. Part of that's probably because historically the market goes up 70% of the time. The catch is that I think most people forget about when we're 10 and a half years into the longest bull market in U.S. history is that, the funny thing about risk is the further people go without feeling the downside of risk, the more they downplay its effect and its impact. So the longer we've gone without a recession, you tend to hear the more flippant, well, the stocks go up 70% of the time and a little downside recession, whatever. And those are the same people that panic sell when the market's down 40% and usually mark the bottom, right? So I think that look, and there's some very credible guys out there, some guys with very good track records who are saying we've got less than a 50%. Take all those percentages and just throw them out the window. What I know is that 100% of the time the yield curve is inverted, we've had a recession within 16 to 20 months. 100% of the time. And in finance, now the one caveat I would throw into that is that, the yield curve relates exactly to, specifically when we're talking about the yield curve being inverted here in the United States, that is addressing and pointed at U.S. government bonds. And there is something that's going on and has gone on in the bond sector that is historically abnormal, which is the Federal Reserve has never printed $3.2 trillion and bought up U.S. government bonds. So what impact does that have on the yield curve? I don't know, but I bet it has some impact. Now, what we don't know is maybe that impact is it's making it look like there's a yield curve inversion, but it really shouldn't be inverting and we have nothing to worry about. Maybe that impact that Federal Reserve's actions over the last 10 years, maybe it means that the yield curve is inverting now, but it should have inverted 6 months ago and we're on the cusp of recession. What I will say is that if you didn't have a lot of faith that central banks around the world could print and stimulate economies, and if you were just looking at PMI indicators and ISM indicators, and you were looking at even new job hirings, for instance, we saw the new jobs report come out recently, and everybody was like, "Oh, that was better than expected." Well, if you took out the people that were hired to do the census, the U.S. Census, which is part-time work, right? That's not a permanent job. New job gains would have been something like 1/5 of what they were reported at. So the economy has clearly weakened, and as we've been saying on the show the last month and a half or 2 months, that I don't see red flashing lights, but there's a lot of yellow lights, a lot of them. And then you look at weakness around the world, you look at rates crashing around the world, and over a very short period of time. I mean, think of this: 16, 17 months ago, the U.S. 10-year Treasury was paying 3.25%. Today, it's paying 1.6. That's a dramatic drop. I mean, that's over a 50% decline in 16 months. And when you see yields head lower that fast, it's never a good sign. Could it end up being overcooked? Sure, but I think a lot of people are kind of rearranging deck chairs on the Titanic. I mean, Yeah, maybe it doesn't come in the next 14 months. Maybe it takes 16 months. But we've got less of this market upside ahead of us than we've got behind us. That's for sure. And I think people are still being a little bit too flippant about the risks out there.
So if a recession does come, some say it won't be another 2008. What's your take on that?
So I never want to be hyperbolic because of what I do for a living. It doesn't. I think if you say things are too good or you say things are too bad, people automatically write you off as somebody that's trying to create smoke and get attention and all that kind of stuff. We never want to do that because we are money managers and sounding good and not performing well doesn't really pay very well. So, we always want to kind of keep both feet on the ground and look at things for what they are. When people say that we may have a recession coming, but they don't think it's going to be severe, I don't really understand that take because I feel like, I don't feel like, when you look back at recessionary history, one of the great indicators of how intense recessions are is the amount of debt outstanding in any given economy and then the credit quality of that debt. Well, one thing that I don't think people are paying a lot of attention to is that if we look at corporate debt, and I think that's important because corporate debt is such a driver, we're talking about corporate America, which is such a driver of employment and wages and all these other things. The corporate debt market has more than doubled in the last 10 years in size. We were at $4.3 trillion prior to the last recession in 2007. Today, we're about 9.2, 9.4, somewhere in that ballpark. And not to mention the fact that that pile of debt is got the lowest credit quality in history. So a bigger percentage of that debt pile is rated BBB than has ever happened in history. It's actually greater than half, which is the lowest level that debt can be rated at and still be considered investment grade. So on that side of it, I would say that you've got the makings for potentially a worse recession. Now, the caveat is, and I think that this is why all the people are saying it, is because we know what central banks are going to do. They're just going to flood the markets with money. Okay. But I think people are making I think they're taking a big leap of faith here that again, this isn't what I'm predicting, but I think this is, again, as risk managers, we need to be looking at this. The big leap of faith is that stimulus, that printed money is going to be just as effective as it was in the past. And there's no guarantee. We've watched over the last 5 years, every single stimulus that China's brought to market has got less and less effective. And we've seen it here in the United States as well. So I'm not convinced that the Fed can keep this going up into perpetuity. As a matter of fact, we know they can't. And that's one of the things that we look at is if something breaks, if a military conflict pops up and creates divisions, right, you quit having cooperation between central banks. So bottom line is, I think that a lot of people are running around looking at this like a normal market. And I think that intelligent bears and intelligent bulls could all come together and agree on one thing, which is there's nothing normal about this market, nothing. And to think that guaranteed the recession won't be worse than 08, 09, there's nothing in the data that confirms that. That's purely speculative. And when you look at the risks out there, like China, we've discussed China before. China's made up 50% of global growth in the last 10 years, 50%. And global growth has not exactly been great, okay? So you've got the biggest driver of global growth that is putting up the worst economic numbers we've seen in 25 years. And they are swimming in a mountain of their own debt, 70% of which is denominated in U.S. dollars. The guys that say there's no big issue, they could end up being right. But the risks out there are massive. And if you got some unforeseen type of thing, when you consider especially the valuations of U.S. markets, when you consider the debt levels of U.S. corporations, I think about it this way. If the U.S. stock market corrected back to its average valuation, not bad, not good, average, you're looking at a 40% drop in the S&P 500. So, again, we're not saying that's happening. I just think a lot of people, because central banks have just been pumping markets, I just think they're very much being blind to the risks. And I think risk management is the key now, and I think it's going to be in the foreseeable future.
That's Zach Abraham at Bulwark Capital Management in Seattle, Washington, and thanks for watching Retirement News Online.